Volatility. Most traders fear it. They see wild swings and they freeze. They think volatility means risk, but I'll tell you what volatility really means. It means opportunity. It means the market is moving with conviction. It means money is changing hands fast, and if you know what you're doing, some of that money can flow into your account. The problem is most traders don't know how to read volatility. They see prices jumping around and they panic. Or worse, they get excited and jump in without any plan. Both reactions will cost you money. What you need is a framework, a blueprint. And at the heart of that blueprint is something most traders overlook: volume. Volume tells you everything you need to know about whether a move is real or fake. Price can lie, price can wiggle and shake and fake you out, but volume doesn't lie. Volume shows you where the real money is committed, and in volatile markets, when you combine trend following with volume surges, you've got one of the most powerful edges available. Let me start by telling you what I mean by trend following in volatile markets. Some traders think volatility and trend following don't mix. They think trends are smooth, steady climbs or declines. That's not reality. Real trends, especially in volatile markets, are violent. They surge forward, pull back hard, then surge again. The traders who make money in these conditions are the ones who can stay with the trend through the chaos. I learned this during some of the most volatile periods the market has ever seen. Prices would swing wildly day to day. Fortunes were made and lost in hours. Most traders couldn't handle it. They'd get shaken out on the pullbacks. They'd second-guess themselves. They'd try to pick tops and bottoms, and they'd lose. I survived and prospered because I focused on one simple principle: follow the line of least resistance. When a market wants to go up, it will go up despite the volatility. When it wants to go down, it will go down. Your job isn't to predict these moves. Your job is to identify them and ride them, and the key to identifying them is volume. Here's what most traders miss about volume. They look at it as a single number. Volume was heavy today, or volume was light today. That's not enough information. What matters is where volume surges happen in relation to price movement and trend. A volume surge at the right moment tells you the market is about to make a serious move. Miss that signal, and you miss the trade. Catch it, and you can ride a powerful trend. Let me break down exactly what I look for. First, I need to identify the existing trend. This isn't complicated. Is the stock making higher highs and higher lows? That's an uptrend. Lower highs and lower lows? Downtrend. No clear pattern? No trade. I wait. Patience in trend identification saves you from getting chopped up in sideways markets. Once I've identified a trend, I'm watching for a specific setup. I want to see a pullback or consolidation within that trend. The stock has been moving strongly in one direction, then it pauses or comes back a bit. This is normal and healthy. It's the market catching its breath before the next leg. Now here's where the volume surge comes in. During that pullback or consolidation, volume should dry up. The selling or profit-taking is light. Nobody's really committed to pushing price the other direction. Then, when price starts to move back in the direction of the trend, I'm watching for volume to explode. That volume surge tells me the trend is resuming with conviction. This is the moment. This is when the smart money is piling in. They waited for the pullback. They accumulated positions while everyone else was nervous. And now they're pushing price back in the trend direction with serious capital. When you see that volume surge confirming the trend resumption, that's your signal. Let me give you a concrete example from my own trading. I was watching a stock in a strong uptrend. It had climbed steadily for weeks. Then it pulled back about 15% over several days. Volume dried up during that pullback. Each day had lighter volume than the last. The stock was consolidating, coiling. I was patient. I didn't try to catch the exact bottom. I waited. Then one day, the stock gapped up at the open, and volume came roaring in. We're talking 3 times the average daily volume in the first hour. Price was surging and volume was confirming it. This wasn't retail traders chasing. This was institutional money committing serious capital. I entered the position that day. The stock ran for another month and I made a fortune. But here's what would have happened if I'd ignored volume. I might have bought during the pullback, trying to get a better price. Then I would have sat through days of the stock doing nothing, my capital tied up, my confidence wavering. Or I might have waited too long for confirmation, missed the volume surge, and watched the stock run without me. The volume surge gave me the exact timing I needed. Now, in volatile markets, this setup becomes even more powerful because the moves are bigger and faster. When a stock surges on heavy volume in a volatile environment, it can move 10 or 20% in days instead of weeks. The opportunity is compressed, but so is the risk if you get it wrong. That's why the volume confirmation is critical. It keeps you out of false moves and gets you into real ones. Let me tell you about the mistakes I've made with this approach, because you need to know the pitfalls. Early on, I would see any volume surge and think it was a signal. But not all volume surges are created equal. Sometimes you get a volume spike that's just noise. Maybe some news came out. Maybe a big trader was exiting a position. That volume doesn't represent new money committing to the trend. It's just a temporary blip. I learned to distinguish between meaningful volume surges and noise by looking at what happens after the surge. If volume stays elevated for several days and price continues moving in the trend direction, that's real. That's conviction. But if volume spikes for one day and then immediately drops back to normal while price stalls, that was just noise. You need sustained follow-through. Another mistake I made was not paying attention to the overall market environment. A stock can have perfect trend structure and a beautiful volume surge, but if the overall market is collapsing, your stock is probably going down too. You can't fight the tide. In volatile markets especially, the correlation between individual stocks and the broader market increases. So before I take any trade based on this setup, I check what the major indices are doing. If they're trending the same direction as my stock, great. If not, I'm much more cautious. Here's another critical element: the quality of the trend before the volume surge. Not all trends are equal. A stock that's been grinding higher slowly for months, making marginal new highs, that's a weak trend. When you get a volume surge in a weak trend, it often fails. But a stock that's been making strong, decisive moves higher, pulling back cleanly and then resuming, that's a powerful trend. Volume surges in powerful trends are much more reliable. Think about it this way. The trend shows you the market's intention. Strong trends mean strong intention. Weak trends mean weak intention. The volume surge shows you the moment that intention is being acted upon with serious capital. When you combine strong intention with serious capital, you get explosive moves. Now let's talk about risk management in this system, because that's where most traders fail even when they have the right approach. You can identify perfect setups with volume surges confirming trends, but if you don't manage risk properly, you'll still lose money. I know because I've done it. When I enter a position based on this setup, I always know exactly where I'm wrong. If I'm buying a volume surge that's resuming an uptrend, I'm wrong if price breaks back below the recent consolidation or pullback low. That's my line in the sand. If price crosses that line, the setup failed and I exit. No hoping, no waiting to see if it comes back. I'm out. The beautiful thing about this approach is that your stop can be relatively tight. Because you're entering on a volume surge that's breaking out of a consolidation, your stop can be just below that consolidation area. You're not risking huge amounts of capital, but your potential reward is enormous if the trend continues. I typically risk no more than 1 to 2% of my account on any single trade using this setup. Let's say I have $100,000. I risk $1,000 on the trade. That means I position size based on where my stop is. If my stop is 5% below my entry, I can only buy a position worth $20,000. The math is simple but critical. This ensures that even if I'm wrong 5 times in a row, I'm only down 5%. I can recover from that. But if I'm right even half the time with this setup, and my winners run for 20 or 30%, while my losers are capped at 5%, the math works heavily in my favor. Let me tell you about managing winners with this approach, because that's just as important as managing losers. When a trade goes your way, when that volume surge leads to a strong move in your direction, you need to let it run. This is where most traders fail. They see some profit and they take it immediately. They're afraid of giving it back. But if you identified a real trend resumption with volume confirmation, that move can go much further than you think. I use a trailing stop once I'm in profit. As the stock makes new highs, I raise my stop. I'm not trying to pick the exact top. I'm trying to stay with the move as long as the trend remains intact. Sometimes this means giving back a little profit when the stock finally reverses. But it also means I catch those big moves that turn a good trade into a spectacular trade. There was a trade where I caught a volume surge in a strong uptrend. The stock was up 12% within days of my entry. The old me would have taken that profit and been happy. But I recognized this was a powerful trend with serious momentum. I held. I raised my stop as the stock climbed. Over the next 3 weeks, that stock went up 40% from my entry. When it finally reversed and hit my trailing stop, I gave back about 8% from the high. But I still banked a 32% profit. That never would have happened if I'd taken my 12% and run. Now, let's talk about what to do when this setup fails, because it will fail sometimes. No strategy works every time. The volume surge might happen, you enter, and then the stock just dies. The trend doesn't resume. Price breaks down through your stop. This will happen, and you need to be prepared for it mentally and financially. Financially, you're prepared because you risked only 1 to 2%. It hurts, but it doesn't cripple you. Mentally, you're prepared because you understand this is part of the process. Not every volume surge leads to a successful trend resumption. Sometimes the market changes its mind. Sometimes that volume was the last gasp of buyers before the trend reverses. You can't know in advance. All you can do is take the trade when the setup is there, manage your risk, and move on to the next opportunity if it fails. What you absolutely cannot do is start second-guessing the system after a few losses. If you took 5 trades based on this approach and 4 of them failed, you might be tempted to abandon it. Don't. Look at why they failed. Were they really proper setups? Was the overall market environment terrible? Were you taking trades in weak trends? Often, when I review my losing trades, I realize I wasn't following my own rules as strictly as I thought. But if you were following the rules correctly and the trade still failed, that's just variance. That's the market. You need a much larger sample size to judge whether an approach works. I don't evaluate my strategy over 5 or 10 trades. I look at 50 or 100. Over that larger sample, the edge reveals itself if it's there. Here's something else I've learned about this approach. It works best when you're selective. You're not taking every volume surge you see. You're waiting for the perfect setup. Strong existing trend, clean pullback or consolidation, volume drying up during the consolidation, then the explosive volume surge as price breaks out in the trend direction. All the pieces have to align. This might mean you only take a few trades per month. That's fine. Quality over quantity always wins. I've watched traders try to force this setup. They see something that's almost right and they talk themselves into it. The trend isn't quite as strong as it should be, or the volume surge isn't quite as dramatic, but they're impatient. They want action, so they take the marginal trade. And marginal setups produce marginal results. Wait for the perfect setup. It will come. One more critical point about volatile markets specifically. Volatility creates emotional chaos. Prices swing wildly. Your positions might be up 5% one day and down 3% the next. This messes with your head. You start questioning everything. But if you entered on a proper volume surge in a strong trend, you need to trust your process. The volatility is just noise. The trend is what matters. As long as price isn't breaking your stop, you stay in the trade. I've held positions through violent swings that would have shaken out most traders. There were days I was down significant amounts intraday, only to have the stock recover and close higher. If I'd panicked during those intraday swings, I would have sold at exactly the wrong time. The volume surge at my entry told me this trend had strong support. I trusted that, and I was rewarded. This is why I keep emphasizing volume. In volatile markets, price action alone will drive you crazy. You'll see constant whipsaws and false moves. But when you anchor yourself to volume, when you enter only on those explosive volume surges that confirm trends, you have a logical foundation for your trade. You can weather the volatility because you know you're positioned with the real money flow. Let me bring this all together. Volatile markets offer the biggest opportunities for trend followers who know how to read volume. The blueprint is straightforward. Identify strong trends, wait for pullbacks or consolidations within those trends. Watch for volume to dry up during the pause, then strike when volume surges as price resumes the trend. Enter with defined risk. Hold with a trailing stop. Let your winners run. Cut your losers quickly. Be selective. Be patient. Be disciplined. This approach has made me more money in volatile markets than any other single strategy. It's not complicated, but it requires discipline and emotional control that most traders don't have. They can't wait for the perfect setup. They can't handle the volatility after entry. They can't let their winners run. If you can master those elements, this blueprint will serve you for your entire trading career. The market will always have periods of volatility. Human nature doesn't change. Fear and greed will always drive prices to extremes and create opportunity. The traders who prosper during these times are the ones who have a systematic approach. They're not guessing. They're not hoping. They're following a blueprint that works. Volume surge trend following is that blueprint. Learn it, master it, and let it work for you.